Investors are soaring through a mixed picture of updates on the labor market, but our next guest still optimistic on the road ahead for the economy and markets. Bank of America Senior Investment Strategist Lauren Sanfilippo joins me here now to discuss. Lauren, it is good to see you. Let's start on the macro, Lauren. You're all calling for real GDP growth to accelerate, nominal over 5%. What gives you the confidence to make that call?
Well, I think we'll find out more on Thursday on the inflation front, but I think inflation's probably sticky here, close to 3%, and that pretty much brings GDP, real GDP, nominal GDP, of course, up. And we're seeing a CapEx boom that's actually filtering through to GDP growth. We're seeing solid consumer spending still. Is there a K-shaped economy? For sure. But, you know, that's sort of the norm we've seen this year. That's going to continue into next year. There's inflation that's still biting at consumer spending. But we heard today from the labor market that there's still an okay picture on the labor front. It's softening, but, you know, it's nothing too dire.
Cooling, not crashing.
Totally.
So if that's the backdrop, what's the base case for the Fed next year? How many cuts?
We think the Fed can cut in the later half of next year, maybe 2 cuts. Right. So I think we see that on the back of the green flag today was that there's still a labor market that's weakening. And again, there's still that sticky inflation, but I think that the Fed is over-indexing to the labor side of their dual mandate.
So if that's the backdrop, this means then what for earnings growth? You must be relatively positive next year.
Right. So a nominal growth that's healthy, that means that profit growth can also be healthy. So we're seeing profit growth of like 14% next year. That's pretty good. I think most of the street's looking for a number around there. That's consensus.
And is that, Lauren, when you call for 14% growth, is that going to be broad? Is that concentrated?
That's the big question, right? Yeah. We've been calling for a broadening now for some time on the basis that Mag 7, there'd be a deceleration from their earnings and then an acceleration from the 493. I think we could actually get that, right? And we've been seeing a bit of a rotation here on the later half of this year, like November on, right? That's been, I think, a little bit more sustainable. And we could see that going into next year, continuation of that, based on the fact that those earnings could actually catch up a bit.
What about the AI story? Here's a stat. Survey from Bank of America, money managers. This stood out to me. Investors' concerns about an AI bubble retreated slightly, they say, from 45% to 38%, though they point out remain the number one biggest tail risk. How do you think through that?
It's interesting, Josh. I hear from our clients actually that based on the fact that some of the froth has come out of that story, it actually feels almost investable here again.
Yeah.
So I think that that's a good thing, right? You're seeing that tech trade at a slightly lower valuation. Okay, that feels healthy. So maybe some of this recent market action is a good thing, right? And the bubble concerns, I think they're a little bit overblown. Still, that fundamentals are tracking well in those names. And so I'm not too concerned about that going into next year.
How do you even, when we talk about bubbles, Lauren, you're talking to your clients about that. How do you even define the bubble?
It's a good point. So I always say, even if it is a bubble, maybe it doesn't have to deflate by 20 to 40%, right? Everyone automatically thinks of like .com, but it doesn't need to be that dire, right? Some of these prices have run up, but again, they're not totally divorced from fundamentals. What
are the sectors? So in 2026, given your views, your clients ask you, where do I want to be overweight? What do you tell them?
Yeah, I think we need to think about bolt-ons next year for some of our portfolio. Bolt-ons in the sense of like, it's about US tech, but it's also about China AI tech, right? I think that there's a significant story that's sort of percolating over there. That also means you don't just have to own chip makers here in the US. It could be a utility story, right? There's still a power story to sort of follow along. So utilities, and that also, we think also benefits industrial stocks, just based on the fact that there's obviously a huge industrial build out. It might be digital, but it's actually more physical, right? So we want to think about some names along those lines. Yeah.
Are there sectors you're less enthusiastic about next year?
Energy, based on a prior segment that you had, I think for a lot of good reasons, right? So it's still a story of oversupply, right? And I wouldn't get too defensive. No one's really calling for a recession next year.
If you're broadly positive on the macro, you think a couple more cuts are coming, does that mean you stay constructive on small caps?
Yeah, so small caps have a lot of good things happening for them. Right now, it's still a solid growth picture, which small caps need. On top of that, you have Fed rate cuts, like relief's on the way. So they have an earnings inflection as of last quarter, right? They finally escaped that earnings recession. So that's been hugely positive for small caps. And so, you know, they get tossed around a bit, right? But I think small caps could do well next year, particularly as another bolt-on.
Let me get you out on this, Lauren. When you're talking to those very smart clients of yours, is there like a theme of their chief worries for next year?
Actually, I'm hearing a lot on the K-shaped consumer. That's actually significant to a lot of folks.
What's interesting, Lauren, our entire adult lives, okay, I feel like I have been told about a K-shaped economy.
Yeah.
So is the idea that it's just getting more K-shaped? Is that why we're focused on it?
So it's definitely getting more K-shaped, right? And I think affordability. I'm going to think about a midterm election year next year. So yeah, I mean, there are certain cities where I hear it a lot from clients actually, and it's almost a good thing. It's sobering.
It's sobering. Lauren, thank you as always for your time. Appreciate it.
Thank you, Josh.
All right, let's get a check now of the day's trading with Yahoo Finance's Jared Blickery. Jared.
Josh, we had a mixed market today and kind of the reverse from yesterday. Dow was lagging today while the NASDAQ was in the green. And let's take a look at the chart of the intraday for the Dow. You can see it was in the green just ever so slightly around the open, but for the most part in the red, closed off of the lows there, down 300 points or 62 basis points, 0.6%. NASDAQ managed to build some gains in the final hour of trading, although it was off the highs, but nevertheless, investors walking away with 0.2% gain. And the S&P 500, kind of a mirror of the Dow chart, or at least an equitable representation of the Dow chart there. Here's Russell 2000. Small caps underwater today by 0.25 percentage point, just a little bit of green early on. And let's move on to the sector action. This is where it gets really interesting because we are looking at some very small gains for these three sectors, managed to build into the close, but you're going to notice XLK, XLY, XLC, those are the three mega cap sectors. And this was maybe kind of a defense trade. We've seen this at various times when the general market is down. Sometimes money goes into those big mega cap names. And here we see that in some of these sectors. Energy, the biggest loser to the downside. Crude having its worst day in months. We're going to dig into that, you and me, Josh, in about 30 minutes. Healthcare also off more than 1%. But I do have a record high to disclose. Record closing high for consumer discretionary, even though the gains were so minimal. That is on the back of Tesla's 3% day where it is closed at its first record high of 2025. Let's take a look at that year-to-date chart, and you can see finally broke out of this big cup and handle. And is it off to the races now? We'll have to see. A lot of times you come back down and you kind of test that breakout level, but I do want to see 470, 480 hold on any kind of pullback here. That happens, we should be off to the races in 2026. Enough on that point. Let's take a look at the Dow and we'll wrap it up from there. You can see, aside from the mega caps, not a whole lot of green. We're seeing some upside action in Disney. That was up about 1% there. And then Boeing was up 0.5%. But for the most part, that energy trade dragging things down a little bit. CVX, that's Chevron down 2%. Some of the staples down 2. Walmart down 1, J&J down 2, Procter & Gamble, as Procter & Gamble, small win there for them. So just on that front, looks like United Health and Merck closing out the healthcare trade for the Dow down, each of those down about 2%, Josh.
All right, Jared, thank you. And before we go to break now, take a listen to former PIMCO CEO Mohamed Al-Arian's outlook for the bond market.
There's tremendous supply from the public sector and from the private sector. Data centers now alone are going at a rate of 150 to 175 billion a year in terms of debt issuance. That is big. Then you have a 6% of GDP deficit. That's big for this part of the cycle. What I worry about is at some stage the bond market is going to say, you know what, we're not pricing in risk the way we should be pricing in risk. That is part of the downside scenario we talked about, is that the bond market's appetite, which has been incredibly strong, somehow becomes less so.
And where do you put that probability?
So I have, and that's not going to satisfy you, I have a 50% probability for the central scenario and about 25% for each side. Okay. And the big message of this, whether you're a policymaker, whether you are a market participant, whether you are a CEO, don't fall in love with your central scenario. Just recognize that it's a multimodal distribution and you've got to pay attention to the tails. And you've got to ask yourself, which tail can I navigate better?
Yeah, I mean, that's a good lesson over the past few years. Don't get too wedded to that central scenario. Speaking of central scenarios and how things shift over time, we've got new betting odds on who's going to be the next Fed chair, right? That Kevin Warsh has really gained in the odds-making market here. You and I have talked before about who the next leader could be. Kevin Warsh, a good choice, better than Kevin Hassett? What do you think?
So Kevin has gone from below 10% Today I looked on Polymarket just before I came in, he was at 47.
Warsh, that is.
Sorry,
yes.
Warsh.
Yes.
And Kevin Hassett is down to 41. So that's a complete transformation.
Yeah.
Now there's some circularity in this because it moved on President Trump's statements, and of course it then attracted people to bet. Look, I have a better view of what Kevin Warsh would do as Fed chair than I do of Kevin Hassett. Why? Because Kevin Warsh has gone beyond the interest rate issue. He has written about balance sheets. He has written about reforms to the Fed. He understands that a Fed that has got its analysis wrong, its predictions wrong, a Fed that has governance issue needs reform. So I'm comfortable with what he favors in terms of Fed reforms. And we know much more actually about what he would look like as a chair.
Coming up, the cyber threat from artificial intelligence and what you can do about it. That's next. Artificial intelligence is marking a paradigm shift for hackers, bringing major changes, particularly in the software space. Yahoo Finance's Dan Howley joins us now with more. Dan.
Yeah, Josh, that's right. Generative AI might be good for things like putting together a quick email, but for coding, it's been especially helpful. But it's also helping cyber criminals. They're able to more quickly put together attacks. They're able to put together emails, whether that's phishing or texting. They're able to go after enterprises a lot more effectively than they previously would have. And so that's raising a lot of questions about how companies, government officials can defend themselves. There's been an incident, Anthropic said that it saw a Chinese state actor use its Claude coding tool to automate or at least partially automate a cyber attack. And then we had seen OpenAI come out with its own warning saying that its latest models could be a high risk when it comes to cybersecurity. And so this is something that we're going to be continuing to monitor. But just as the hackers get a leg up, they are usually ahead of the defenders. The defenders are also getting a leg up where they're able to more quickly triage incidents or deal with things in a way where they may have needed to be more expert in their domain. Now they'll have some tools that they'll be able to use through generative AI to really kind of step themselves up. So it's this kind of ongoing cat and mouse game that's now just been supercharged thanks to generative AI.
All right, Dan, thank you. Appreciate it. Well, cybersecurity is heading into a pivotal year, bringing some of the biggest shifts the industry has seen. Companies in the sector expecting threat actors to use AI to uncover vulnerabilities faster and weaponize victims' own AI systems. For more, we're bringing in CrowdStrike President Michael Sentonas. Michael, it is good to see you. So maybe start at a high level, Michael. When you look into the new year, 2026, I'm curious how you see the threat landscape evolving, Michael, how it compares and contrasts to 2025. I mean, one point you made here I thought was interesting. You say zero-day vulnerabilities could surge. And maybe start there. What is a zero-day vulnerability, Michael? Explain that for us and how companies can best position for it.
Well, I think zero-day vulnerabilities are a problem that has plagued the industry for a long time. This is where an attacker finds a vulnerability, a flaw, a weakness in an application, a service, a system that has never been found before. And they're not necessarily that easy to find. They're not. It takes a lot of research. It takes a lot of cost. And I think with AI, what we're going to see is the time it takes to discover new vulnerabilities is going to dramatically decrease. And what that means for an end user, for an organization, is they're going to have to respond to more and more attacks and roll out patches which are already at the point of breaking organizations because there's just so many vulnerabilities. And this year we saw speed and precision be something that the attackers use to their advantage with AI. In 26, I think we're going to see prompts become the new malware. And that's where attackers are using AI systems themselves to inject their tradecraft and actually damage the very systems that offer so much promise and ability for us to improve our businesses and our lives.
Another point you made here, Michael, I thought was interesting. You say AI will ultimately help defenders, though, more than attackers. That's interesting. What does sort of effective defensive AI look like, Michael?
I think all of this technology that you talk about all the time with AI and the benefit that it provides, unfortunately provides significant benefit to the attacker. They have the ability to use this to their advantage. They don't have boards. They don't have the same management systems that we all have. They don't have regulators that they need to think about. So it gives them a huge leg up. But from a defensive perspective, we get to use that tool as well. CrowdStrike's been at the forefront of doing that for over a decade. We continue to build that into our models. Everyday users of this technology can become better defenders through the use of this tool. They can respond faster. They can respond with greater precision and skill that may take them years to normally learn. They can use these techniques and tools to their advantage. So I think I'm super positive going into next year that there's going to be a lot of benefit that comes from AI to us as defenders. It's not just going to be a tool for the benefit of the attacker.
And when we talk about the attacker, Michael, where are these threats coming from? I mean, is it rogue states, criminal gangs? Is it lone wolves? And what are they after? Is it data, information, ransom?
This is a great question, because traditionally when we talk about cyber attackers, we talk about the same nation states: Russia, China, North Korea, Iran. We talk about sophisticated e-crime groups that are motivated by financial gain at somebody else's expense. Unfortunately, what we're seeing is a democratization of tradecraft, a democratization of destruction in many ways. What do I mean by that? Attacks that took months and millions of dollars can now be developed in minutes for dollars. And if you want to commit a crime, you can do it through the use of these tools. We're basically seeing the tradecraft that once was the domain of a nation state is available to anyone. And that's what makes this next evolution, this next period that we're going through, so dangerous.
Michael, what does this all mean for CrowdStrike, your company? The threat is real, it's growing. What does differentiate, Michael, your platform, your technology from rivals? What's the competitive edge?
Well, it starts with where your question goes. We have one platform. What differentiates our platform is a single platform, a single endpoint, a single store of data that helps us stop breaches in a way that our competitors can't. We don't push out complexity into the hands of the user of the technology. We focus on having the best defense and the best protection. We saw that in the MITRE attack evaluation last week. 100% detection, 100% prevention, and zero false positives with a really easy to use platform. So it's really making sure that we can keep up with the modern adversary, but do it in a way that doesn't exhaust the end user. And I think we've demonstrated that time and time again in the way we stop breaches.
It's interesting, Michael. Is that a trend there that you see more businesses, more customers, they want to sort of consolidate their cybersecurity tools? They would prefer an all-in-one solution?
They do want that, and they're getting exhausted with vendors that are making them become systems integrators. They're getting exhausted when they have to try to get products working together that were never designed to operate that way. It's great to as a vendor, buy an unlimited number of vendors and then force that down to an end user to try to work out and make sense of all of that. And what we're hearing from customers is we don't want that anymore. We want to have the best protection. We want to make sure that we can defend against these nation states and e-crime actors and people that just want to do bad things online. But you have to think about us as users of the technology. It needs to be simple. It needs to be easy to use. We want one platform, and I think that's what resonates with customers so well and why we're going from strength to strength, because of that single cloud architecture that we have, single agent architecture. It's just easier to use.
Michael, great to have you on the show today. Thank you.
Thank you.
I got breaking news here. Warner Brothers Discovery is reportedly set to reject Paramount Skydance's hostile takeover bid as early as Wednesday. The board raising red flags about the financing structure and overall terms of the offer that's, according to published reports. Warner Brothers believes its deal with Netflix, which values the studios, HBO, and the streaming business at nearly $83 billion, including debt, offers greater certainty and better protections than the proposal from Paramount. One major concern, much of the equity backing Paramount's bid comes from a revocable trust tied to Larry Ellison. The board is also worried about Paramount's terms limiting the company's ability to operate freely during the regulatory review. This news now leaves the ball in Paramount's court to decide whether it will make a sweetened offer. Paramount has tried to ease concerns, even withdrawing $1 billion in 10-cent financing over national security worries, and previously said its $30 a share offer is not its best and final. Time now for what to watch Wednesday, December 17th. We're going to start off on the earnings front. More reports rolling in on Wednesday, including Jabil, General Mills, and Micron. Micron announced the results for the first quarter after the markets close. Analysts expecting Micron to beat its sales and profit forecast because memory prices keep climbing, signaling a continued shortage of supply, and that shortage may last into 2027, driving prices higher. Price growth may cool early next year due to companies sitting on extra inventory, but that should pick back up later in 2026 because of strong AI-driven demand. Taking a look at the Federal Reserve as well, we're going to be getting another round of Fed commentary on Wednesday, including New York Fed President John Williams. Williams saying on Monday that monetary policy is well positioned for 2026 amid increased risk to employment and somewhat lessened inflation risk. This is coming after the Fed cut interest rates by 25 basis points at December's FOMC meeting and ahead of another critical piece of inflation data on Thursday with the November Consumer Price Index. Well, that's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. And I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.